So let's talk about midterm renewal. That's what you wanted to discuss first.
A lot of people are coming up for renewal, Todd. Obviously, I think that in 2017, it was quite busy as well. And majority of Canadians take a 5-year term.
Right.
And whether that's a variable rate mortgage or whether that's a fixed rate, that's kind of the norm. And when people are coming up for renewal right now, let me tell you, they're getting a little bit of shock.
Yeah.
The rates are obviously higher now than they were even a few months ago or a year ago. And, if you were in a low fixed rate and you're coming up and you're looking at where the rates are now, you're going to really have a big payment shock as well. And those consumers that are feeling the payment shock, it's not just the payment of the mortgage that they're really concerned about, Todd. And sometimes that's the least of their worries. What they're concerned about is everything else that's outgoing from their wants and their needs that are coming out of their bank account and their credit card every month. And what we're doing, and we're having a lot of these conversations with customers, and this is why a lot of people are taking a variable rate right now. The variable obviously is lower than where the fixed rates are. And we believe that obviously the Bank of Canada is going to lower the key overnight rate, in the coming months and years when inflation comes under control. If you take a fixed rate right now, you're paying for that security. But what happens when things go down? You may really be sad that you're in this rate over the next 5 years.
Right.
So right now, a good fixed rate is, maybe a little bit under 5%. Some are paying, as low as maybe like 4.75. Some are paying as much as 5.25%, 5.5%. If you do take the fixed rate right now, you're stuck with that.
Mm-hmm.
And with the variable, we may still see some more increases. The Bank of Canada is meeting again in September. And some economists think that we're going to see another increase, but things are going to start leveling out. At least that's what we think.
Yeah.
And then when the Bank of Canada decreases the key overnight rate, guess what? If you're in that variable rate, you're going to start appreciating a lower interest rate. And what happens if fixed rates do come down? Certainly the bond yields haven't been as crazy as they have been. So I think we're going to start seeing some softening in the fixed rate. So I think that's something to watch. But regardless of your variable rate or your fixed rate, when you're coming up for renewal, your amortization is staying in line with where you're at. A lot of customers are coming in to see us and they're wanting to do a refinance. And Todd, they're not necessarily wanting to do a refinance to pull out any equity. Mm-hmm. They're doing a refinance and they're extending the amortization to 20, 25, 30 years to lower their principal and interest payment. And it's not so much that they can't handle the mortgage payment. It's to give more payment relief for everything else that they're spending right now.
Right. What about the stress test? Because that must be...
That's really interesting, and
Yeah.
we've been talking about this a lot. So even if you take a variable rate, because the variable rates now obviously are higher than what they were,
Right.
we're qualifying, I would say 100% of transactions at whatever the contract rate is plus 2%. So it's a lot harder to qualify today than it was even a couple months ago.
Yeah.
So for example, if you take a fixed rate at 5%, we are qualifying you at 7%. Mm-hmm. That is aggressive.
Yeah, that's aggressive.
Yeah.
That's putting a number of people out of the mortgage market right now.
I agree. And that's why with some of these consumers, you don't requalify when you're up for renewal,
Right.
Especially if you are just renew with your existing lender.
Yeah.
The challenge is existing lenders know that.
Yeah.
And that's why typically when renewal offers go out, they are above what's available in the market. So some people get stuck. Some people wait too long.
Yeah.
And then the renewal comes up and maybe their lender doesn't offer an open term and they just have to renew with their existing lender.
Yeah.
Other consumers take the renewal because they really can't be bothered.
Yeah.
Those ones typically spend more money. I'll be honest
Some
with
of them
you.
don't open their mail.
Some of them
They don't even know it renewed.
And they auto-renew.
They don't even know it
Sometimes
renewed.
they auto-renew into an open at like 8%.
Same as their house insurance and their vehicle. They don't even know.
And sometimes
that's
those
going
things,
up and up and up
and
every
sometimes
year.
those things lapse.
Yeah.
And, there's some lenders that...
I shouldn't laugh. But
It honestly, it happens.
Yeah.
There's some lenders that if you don't renew, it'll actually put your mortgage into a default position.
oh, Lord.
Open your mail. Our customers get a postcard from us 6 months before renewal, and we really start getting on to them at 4 months.
And you guys do reviews as well.
Yeah, we do an annual review with our customers, and oftentimes during these annual reviews, we're talking to people about inflation. And we're giving a lot of advice right now, and we're giving advice even if we're doing a transaction or not doing a transaction, which I think has a value. some clients are choosing to break their mortgage early. Maybe not people in a fixed rate, because usually, you know, they're okay right now. Yeah. But some people that are in a variable rate are choosing to break their mortgage early, Todd.
Yeah.
And extending their amortization.
Yeah.
And they're not taking a new fixed rate. They're taking a new variable,
yeah.
but they're taking a longer am.
And that's to get their payment down.
Yep. Yeah. And they tell me, they're like, Clinton, this is just for a year or 2 years. And then they're going to take advantage of a lump sum payment or a payment increase when the consumer goods kind of come under control.
It's not for everybody. There must be some scenarios where you look at them and you say, this is not the right move for you.
Like now. Stay the course.
Yeah.
Like I have some customers that are in very, very low variable rates. I have a lot of customers at prime minus 100, prime minus 110 or better. Yeah. And I tell these customers, unless you're really in financial hardship, don't break your mortgage. Your rate now is below what's available in the market. Typically in a refinance situation, we're somewhere around prime minus 40 or so right now. So you're looking at a rate at 4.3%. And if you have prime minus 100 or prime minus 110, if you can swing the payments and you're okay, ride it out. Yeah. Because if you can ride it out, it's obviously going to be cheaper for you. And maybe it's something that we revisit kind of down the road. Yeah. But there are certainly some consumers that we just tell them to be like, you just need to stay the course.
Right.
And that's okay too.
Yeah. Yeah. Yeah, there's so many moving parts right now. I mean, it's just people need to be informed. And that's why, in all honesty, not to pat ourselves on the back, because it's not this about it, or your commitment to this. It's really your commitment to this that's made this happen. But this is extremely important, this information that people have. People listening right now could literally save themselves massive headaches just if they took a little advice from the last 5 minutes.
Yeah, exactly. It's like, first, open your mail.
Yeah.
2, let's look and see how much you're spending every month.
And 3, engage with your lenders.
Yeah, exactly. Are you in the best product?
Right.
And, you know, is that amortization meeting your needs in terms of paying it down, but also your monthly output? Because the interesting thing is, a lot of things change in people's lives. Yeah. You know, they get married, you know, they have kids, they get separated, you know, they do career changes. A lot of Canadians are becoming self-employed. The needs are different today than maybe they were a couple years ago.
Yeah.
And that's okay.
Yeah.
But I think evaluating where you're at is important.
Yeah.
And you can't always do it because, you know, you might lose sleep at night.
Yeah.
And we certainly do have some, and I'm going to say very few, clients that are in a variable rate mortgage that are losing sleep at night. And maybe some of our listeners are, Todd.
Right. I'm sure
people are concerned.
But again, I think if people are educated, and I don't say that in a negative way at all.
It relieves a lot of that stress.
Because knowledge is power, and a cliche time here in Mortgage 101, but it's true, isn't it?
Knowledge really is power.
Yeah.
And the one thing that I do tell customers, if you are losing sleep at night and you're okay paying more money, you can convert into a fixed, but it may be converting at a rate at 5.5%. Do I think that's the best thing for people? I personally don't.
Yeah.
But if you are losing sleep at night and you're okay paying more just to have that peace of mind, maybe that has a value.
What if people want to refinance and do improvements and all of that? Is this? I might have missed the boat a little bit. Some people on that.
You know, I think depends on what market you're in.
Yeah.
You know, the values in Halifax are still quite high compared to maybe some other areas of the country. So it could be a really good time to refinance. If you're one of our listeners in Ottawa and really across Ontario, the market really has slowed. And what happens when the market slows, the values also maybe have decreased maybe a little bit. When we look at doing a refinance, it's up to 80% of the market value of the home. And the market value is determined by what comparable sales look like for similar real estate in your market, in your street, in your neighborhood. So I think that's something to take into account. You know, if you had bought a house 2, 3, 4, 5 years ago, typically you do have enough equity that you can do a refinance and it would make sense. That's not everybody's situation, you know, across the country. Some markets, the values haven't grown as much as they have, you know, here in Halifax. And I know obviously in Ottawa as well. So it's something to think about. think about what the market value is of your home if you were to sell it, and that's the value that we would use, and then take 80%, and then you have to pay out your existing mortgage and any secured debts, and that's the basically equity you would have to use.